Okay, let's get started. Very loud. Very loud indeed. Okay, we finished up a history of money. And the punchline of this is, first of all, you should know where we come from and why we're here, but to realize that this idea that we're all using monopoly money, we're all using fiat money, is really super new. Okay? Doesn't feel new to us, because 50 years is a long time for a human, but in this span of human history, it's super new. And we as a profession and we as a society are still learning how it works. And it has never gone through, at a global scale, a big crisis. So we don't know what's going to happen then. Okay. So now let's go back to what is money. And we've said that money is going to be anything that serves the function of money. And we've listed three functions: the medium of exchange, the unit of account, and the store of value. We are going to particularly focus on the medium of exchange, because that's what we use money for. Well, one of the things we use money for every day, and that's going to be the one that we're going to be paying attention to, but these ones are still there in the background. And in fact, there's more things that money does if you want to read about them, but these are the three main ones. So I can think of things that sort of serve as money. For example, cash. If you have a euro note, you can go out and you can buy stuff, right? Well, you can buy stuff, and that person will accept your euro note because they think that they can pass that euro note on to someone else. It's not that they want the cash, it's that they want the stuff that the cash can buy. Right, so it is serving as a medium of exchange. Now, interestingly, if I did this lecture, say 7 years ago, which I did, that was sort of the standard, right? Cash is king. You can buy anything. You can buy everything from drugs to bubble gum to whatever. You can buy anything. Now it's not quite as easy, right? There's places that won't take cash, that will only take bank cards. Or they'll make a face when you bring them the cash. And I don't know, I'll go find the register and find the change for you. It's not as good a money as it used to be, actually. Right? It's still pretty good, and it's still, the choice way to buy illegal stuff. But it certainly serves as a medium of exchange in our society. We can also think about checking account balances, money that you have in your checking account. Right? We think of it as money that you have in your checking account, but it's a balance that they're saying that the bank owes you money. Right? And for us in our society, that is super easy to spend. Right? You just take your laser card and you go ping, and then you've bought the thing. And so if you're thinking about money as a medium of exchange, whatever you have in the checking account is useful to you for buying stuff. Right? If you go into the weekend and you have no cash, but you have a checking account balance, you still think you can go to the movies on Saturday night, right? Because you just say, oh, I'd like to go ping, and it'll be fine. And so your ability to buy a movie ticket is fine as long as you have cash or checking account balances. You can buy a movie ticket on the weekend, right? And so checking account balances also serves as a medium of exchange for us in our particular society. Now, it used to be, back in the day, that we didn't have these laser cards, and we didn't have, this is way before your time, but we didn't have, when I was young, we didn't have ATM cards either, right? And so to get your wealth out of your checking account, you either had to physically go to the bank, or you could write a check. And some places would take your check, and some places wouldn't. Now we don't even have checks, but we call them checking account balances. We kind of do, but not really. So it was harder to spend back in the day, but now it's super easy to spend, right? And you can see that these things, what serves as money, is going to really depend on the society we've got, the technology we've got, and how we've organized things as a group. But certainly today, if you want pizza, you want a movie on the weekend, if you've got something in your checking account, you can spend it on a whim, right? It is not a problem to spend it. It is, in fact, in many cases, easier than having cash. You could also have some wealth in stocks. You could own a portion of IBM. A stock is just a certificate saying you're a part owner in that company. And you could be a part owner in IBM, and you'd be a very, very small part, but nevertheless an owner of IBM if you had a stock. And you could have some wealth there, right? And for you and me, if you have wealth in stocks, it's kind of hard to get a pizza on Saturday night. Right? I got My uncle died, he left me his stock portfolio. Woo. And I got this giant stock portfolio. It's sad about the guy, but I got the stock portfolio. That's the important thing. And now it's Saturday night, and I'm just enjoying my stock portfolio, and I want pizza. I can't get it, right? It's not something that I can actually get on Saturday night. I have to wait till Monday, sell my stock, get the cash, and then do the thing. So it's a bit harder to use than these other things, A and B. On the other hand, so me and you, we don't really use stocks as a medium of exchange, but in fact, companies do, right? If you're a billionaire and you want to buy another company, you can use your stock in some other company to buy it and just do a swap, right? And people will accept that, not because you want, very famously, what's his name? Elon Musk did this to buy Twitter. He said, I got all this Tesla stock, and I will use that to buy Twitter. And then he borrowed on the stock. It was a complicated deal. But you can use the stock that you've got to buy something else, right? And the people will accept your stock not because they want that particular stock, but because they know that they can sell it off and use that to buy something else, right? And so stocks for some transactions actually can serve as a medium of exchange. Not for me and you, but for companies. They are used for these big purchases as a medium of exchange. I give you a bunch of stock, you give me your factory, and then later on you liquidate the stock and you use it. And I can actually buy a factory using my stock in a company, if I'm a big thing and we're doing a big deal, right? Bonds the same way. Bonds are just an IOU. If I buy a bond from the Irish government, that means I am loaning the Irish government money. This is making funny sounds. Okay. I'm loaning the Irish government money, and they are going to pay me back over time. That's all a bond is, just an IOU. Okay? Now, you and I we don't do IOUs that way, but big companies, countries, they do IOUs that way, and they call it a bond. Right? And so if I have these bonds saying the Irish government owes me lots of money, I can't get pizza on a Saturday night. But if I'm a big company and I want to buy a factory, yeah, I can say I have all this Irish government bonds. Let me give them to you in exchange for your factory. And companies do this all the time. So stocks and bonds don't serve as money, medium of exchange for us, but they can and do serve as a medium of exchange for big companies in these big purchases. Okay? Gold back in the day, you remember we had the gold standard and we had metallic money and that was a thing? And back then, gold was money, D&D land, but also historically, it was the gold standard. It was the thing that was the most money-like. It was served as our medium of exchange. But now, not so much, right? If you have a bunch of gold in find that your uncle hid a bunch of gold in the walls, which my grandmother did, because she was expecting the zombie apocalypse. Grew up in the Great Depression, so all gold in the walls. So there was gold in the walls when she died, and everyone tried to find the gold in the walls. We got the gold in the walls. You can't get pizza on a Saturday night, though. You got a lot of wealth, but you can't get pizza. In our society, it is kind of a pain to get your gold turn your gold into a pizza, right? You have to go find a gold buyer, and you have to do the swap and all of that. Now, this is society dependent, right? If you're in Turkey, for example, I use Turkey as an example a lot because my wife is Turkish, and so I know a thing or two about that. Not a lot, but some, right? If there, women in particular save in terms of gold, right? And so there's lots of gold swapping. And so if on a Saturday night you want pizza, it is pretty easy just to go down and swap your gold for Turkish lira and use that to buy a pizza. It's not as easy as having cash, but it's pretty simple, pretty straightforward. Just the guy to talk to. You'll get a good deal. In our society here, not so much. It's going to be a big pain to swap your gold for euros and get your pizza. It can be done, but most of the gold buyers are kind of predatory. They're looking at people that are low information sellers, right? And they're making a big profit on it. And so it's more of a pain here than it is in Turkey, and it's more of a pain in Turkey than it was back in the day. So in our society, yeah, you can swap gold, but it's kind of a pain. If you have your wealth in gold, it's kind of a pain to buy stuff. Right? Comic books. Now, we don't normally think about comic books as money, but I can assure you when I was a kid, lots of kids were swapping comic books. Right? They're swapping comic books to get the comic book they want, but also, if Joe had a Spider-Man 72, and I also had a Spider-Man 72, I would still accept Joe's Spider-Man 72 in an exchange because I knew I could pass it on to someone else. So in fact, for some kids, comic books, Pokemon cards, whatever, can serve as money. People can accept it, not because they want it itself, but because they know they can pass it on to someone else. Right? All right. Which is to say, now cows the same way. For me and you, we do not swap cows. I don't know. I don't know your life. You may be swapping cows day and night. I don't know how you live your life and what your apartment smells like or anything like that. But for most of us in today's society, we don't swap cows. But in fact, farmers do. Right? Farmers, if they say, I want to buy your land, I got some cash, I got some cows. Yeah, they could do this swap and the guy can sell off the cows. It does happen. It doesn't happen to me and you, but it does happen in farming communities at times. I've seen it happen my own self. And so because cows are sometimes used as a medium of exchange, by our definition, anything that serves the function of money is money. And so cows are money. All of these things are money because they are sometimes used as a medium of exchange. And of course, they're also used as a store of value, but we're focusing on the medium of exchange. So all of these things, from our definition, are money. Right? So gold used to be great money. Now it's kind of crap money, but it's still money. Right? Cash, checking account balances, clearly very good at being money. Right? If you have your wealth there, it's very easy to get a pizza. And so, but these things farther down are less good at being money. Now, I have actually put these down in a vague order, right? I put them down from the things that are kind of in our society best at being money, down to the things that are less good at being money, right? And this is, the order I've put them is roughly an order of liquidity. Liquidity is a jargon, right? And we're going to talk about liquidity quite a lot. Liquidity is just the ease of spending. How easy is it to spend in our particular society? So if you think about liquid, if you try to hold liquid in your hands, like water, to hold liquid in your hand, it runs through your fingers, right? And you may have tried this yourself. If you try to hold money in your hand, so it's gone before you know it. So they both have this feature that they kind of disappear from your hand when you try to hold on to them. And that's the thing. How easy is it to spend? How easily does it flow through your fingers, get converted into something else? And these things in our particular society are particularly easy to spend that wealth. And these things are more difficult in our society to spend that wealth. But you can still do it, and it still serves as a medium of exchange in some transaction somewhere. Okay? So we're not really thinking about what is money, what is not money. We're thinking more in terms of how good is this thing at being money, and how bad is this thing at being money. In our society, in every society, absolutely everything is money. Somebody somewhere is doing a swap with that thing, not wanting the thing, but expecting to pass it on to somebody else. So everything is money. Chewing gum is money, everything. Absolutely everything is money, but some of it's very good at being money, and some of it's crap at being money. But it's all money. Okay? Oh. Well, this is Microsoft, man. Have you noticed that Microsoft thinks it owns your computer? Okay. Yeah. We'll fight with it. We'll fight. They're going to win. Of course, they're going to win. But we'll fight with Microsoft for a little while. Okay. All right. Oh. All right. So we're going to have some definitions, and these are arbitrary, and they're based on society, but we're going to think about how easy things are to be money. These used to be like really important. These definitions are getting less important as we go along because society is, well, we'll see. Society is changing, and so these definitions are less useful than they used to be, but it's still useful to think in these terms. Let's take things in our society and order them by liquidity, by how easy they are to spend. So M0, M for money, 0 for zero, is going to be stuff that's really super easy to spend. And traditionally, this is notes and coins. Okay? In the last 5-7 years, this has been changing a bit. Like notes and coins are not as easy to spend as they used to be, so we may have to alter these definitions going into the future. But at the moment, we're still thinking the easiest thing to spend is notes and coins. And certainly, Certainly, if you want to buy anything illegal, notes and coins are king, right? But lots of other things. Notes and coins are generally good for buying stuff. So notes and coins we're going to think of as the most liquid, and we're going to give them the name M0. Okay? And then M1 are going to be things that are very easy to spend. Maybe not as easy to spend as M0, but still pretty easy to spend. So it's going to include all the notes and coins, and in particular, we're going to add also checking account deposits here. Right? If you have wealth in your checking account, in our society, super easy to spend. Ping, you've bought something, right? And so the fact that you have it in your checking account, it makes it pretty much just as easy to spend as if you had it in cash, okay? In our society. Now, you have a daily limit, right? You can't spend over, say, 600 euros that way. And so it's a little less flexible. You can't go just ping for 10,000 euros. You have a limit. Whereas if you had 10,000 euros cash, you could buy a car on a whim. Not so much in your checking account balances. You have to wait till Monday, make a bank transfer. Or go to the internet, make a bank transfer. It's going to take 2 days to happen and all that, right? It's a little less easy to spend for some things. But for our daily life transactions, things in the checking account, just as easy to spend as money. Maybe even more so. Money, notes and coins. See, it's very easy to go back and forth between our economics definition and the English definition, but they're not the same, right? When I say money, I'm wrong. It's actually M0. Notes and coins. Okay? And we also include overnight deposits. So if there's some time deposits in banks where you're going to get interest if you leave it in for a certain amount of time. If it's overnight, like you get it back in 24 hours, we're going to include that kind of arbitrarily in M1. I think traveler's checks are there. Traveler's checks used to be kind of a big deal. Or they're not a thing anymore, really. They still exist technically, but there's a few other things in here, but the important thing is to think M1 is stuff that's very easy to spend, and very importantly, it includes checking account deposits. Okay. M2, things that are pretty easy to spend, maybe not quite as easy as M1, but still pretty easy to spend, and this is going to be M1 plus short-term time deposits. Now there's also a distinction between checking accounts and savings account balances. These used to be a big deal. They're not such a big deal anymore. Right? They both have a laser card, so it's pretty much the same thing. But short-term time deposits, I will have, like I can go to AIB and say, I want to put my wealth into an account and I want it to pay interest, and they'll say, well, put it in for 30 days, and we'll give you some interest on that. Okay? And if you take it out earlier, you're going to lose the interest. Or depending on the deal, maybe they'll say, you cannot take it out earlier, right? And then they're pretty sure that you're going to leave it in for a certain amount of time, and they can make good investments with it and so on. But importantly, it's not as easy to get out, right? If you take money out of if you take wealth out of your checking account, you lose nothing other than the wealth itself. Whereas with these short-term time deposits, if I want to buy something tomorrow, I'm going to lose the interest on that. So I'm losing something by taking it out. It's not quite as easy to spend. And probably I don't have a laser card to take it out. I have to go online, switch money from account to account, and then use my laser card. So it's a bit more of a pain. Okay? And so on and so forth. And we can go up to M25, M42 if we so desired, just making things that are less and less and less easy to spend in our particular society. Okay? Now, they don't go up to M25. Nobody cares enough to make those statistics. But I think they do go up to M5 or so and keep track of the statistics for these things. What is the money supply of M0, the money supply of M1, the money supply of M2, and so on and so forth. Okay. So we can do this, and we can feel all scientific because now we've named things. But you can see from our previous list, if we go back to our previous list. No, that's not. It's too far back. Our previous list of cows and checking account balances and all that stuff, that we were kind of arbitrary in these things, right? It's not clear exactly whether overnight deposits should be here or here. Sometimes checking account balances are easier to spend than notes and coins, and yet we put notes and coins above. It's a little arbitrary. Okay? But from our point of view for this class, and for you to understand anything that comes after this, we are very importantly, when I say the word money, from now on, we are thinking M1, maybe M2, but we'll think M1. We'll just fix one, right? Importantly, we are including checking account balances as money. So when I say money, we're really supposed to be thinking checking account balances. And if you look at M1, people hold some notes and coins, but in fact, checking account balances are way bigger than notes and coins. Now, this is hard for students to grasp because students by and large are poor, and so they don't have lots in their checking account. And they're kind of, the checking account's 100 euros, the cash is 80 euros, they're kind of, But in society as a whole, checking account balances are way, way, way higher than the amount of cash. And you can think just someone, a richer someone is obviously going to have, not infinite, if they're 100 times richer than you, they're probably not going to have 100 times more cash, but they will have 100 times more checking account balances than you, right? Because they keep most of their wealth in checking accounts. And so checking account balances for a richer person are going to be a higher proportion than they are for a typical student. But in fact, we should really be, when we're thinking about checking account balances, we should really be mostly thinking about corporations, right? And if you think about corporations, let's think about Hewlett-Packard and their troubles. Poor Hewlett-Packard, though, they have so many troubles. Let's think about them and their troubles. And they've got some things that they need to buy cash, right? Sinead out at reception, she has petty cash in that drawer. It's kind of in a wad, right? And there's like $50 in petty cash. So if somebody, somebody dies on the production floor, she can go out and buy flowers real quick. Again, someone dead on the production floor. So Sinead's got some cash. But aside from Sinead's 50 euros, nobody in that company, right? The people do, but the company doesn't have cash anywhere. It's all checking account balances, right? Because they don't have need for cash. They don't buy stuff with cash. They put in purchase orders. They do money transfers. When they pay people, they have to pay them from a bank account to a bank account. And so every month, for example, Hewlett-Packard has to pay all its engineers and cleaning personnel, and Sinead and everybody has to get paid. And so all of their salaries have to be in a bank account somewhere so that they can transfer that money to someone else's bank account as they get paid, right? So all of that, everybody's salary has got to be in a bank account somewhere, right? And so we think about Hewlett-Packard's checking account balances, hundreds of millions of euros, 50 euros in cash, right? And when they buy, they buy solvent and they buy politicians and all that stuff. They buy them all with checking account balances. They don't buy them with cash. Well, politicians they buy with cash. But other than that, they buy them all with checking account balances. And so corporations have huge checking account balances, successful corporations, and they have very, very little in cash. And even unsuccessful corporations have checking account balances and very little amounts of cash. And so when we think money, when I say the word money, you should be thinking checking account balances. This cash, these notes and coins, are very secondary. Right? If Hewlett-Packard wants to buy something, they say, let's buy 100 tons of solvent to make computer chips. Great. Can we afford it? They look at the checking account balance and they see, yeah, we got the money in the checking account balance. And so then they can buy it. Right? They don't look in Sinead's drawer to see how much petty cash is there. They say, yeah, we got it in the bank. We're going to buy it. And so we're thinking of money, and we're going to be particularly thinking of money in terms of how easy is it for people to buy stuff, right? If you've got money going into the weekend, either in your checking account or in cash, you can buy a pizza on Saturday night. And if you don't, you can't. You might have a big stack of gold. Doesn't matter. You can't get a pizza on Saturday night. You've got wealth, but you can't buy a pizza. If you've got this liquidity, either through cash or through checking account balances, you can, if you want to, buy a pizza Saturday night, right? And the same thing is true for corporations and so on, right? So we are going to be thinking of money as particularly checking account balances, okay? This is the crucial thing. Like if you spaced off and didn't notice this sleight of hand, nothing that comes later is going to make any sense. Money means checking account balances for our society at this point in time, okay? Okay. So now I'm going to talk about banking, right? And so we're talking about money, and we're going to talk about interest rates. And we've defined money as being primarily in our society checking account balances. And so now, all of a sudden, we have to start talking about banks, right? Because checking account balances are a figment of the banking system. So if we don't understand how banks work, we can't understand how money works, because money is mostly in the bank, right? So if we're talking about money, and we are, monetary policy is one of our great tools of macroeconomic stabilization, we need to talk about how banks work. Okay? And so to do this, I'm going to start out thinking, what if I wanted to start a bank? And this is a really good thing for me, because I could be rich. Bankers do well. So I'm going to start a bank. And what I'm going to do is I'm going to do the Bank of Ivan. And the thing about me is my sandwich business didn't work out. I got shut down by the health and safety guys. And I got to make some money on the side. And so I think about you guys, captive audience. Every Tuesday and Thursday you're here. And so I can start the Bank of Ivan. Right? And you don't have to go to AIB, but every Tuesday and Thursday you're here. So what I'm going to do is I'm going to take this place here, and I'm going to make it marble. I'm going to have a big desk made of marble and like little teller windows and stuff. It's going to be a little expense to make everything marble, but it's important that you think the Bank of Ivan is stable. So I'm going to marble everything down here. And then I'm going to get you guys to deposit your money in my bank. Okay? This is exactly how banks work. It's no different. I'm just some schmuck opening a bank, and I get you guys to put money in the bank. So suppose you come, because of the drugs have addled your mind, you come and you give me 100 euros and say, I want to put 100 euros in deposit, right? I give you a little bank book that says, here's your bank balance. And that's basically just me saying, I owe you 100 euros. It's just a little IOU. You've given me 100 euros, I give you a bank book that says, I owe you 100 euros. Right? Same thing AIB does, is exactly what happens. And now I am a bank. I have taken deposits, and I say, don't worry. Anytime you want your 100 euros back, or part of it back, just come to me. I'll give it to you. Right? Perfect. And you're saying, that's great, because Ivan has a vault, and he'll keep it safe. And it's, my roommates always steal my cash, so now it's out of my hands of my roommates. So that's great. And everyone's happy, right? And we're going to pretend, and this is a leap, that you're going to have trouble believing this, but we're going to pretend that I'm honest and don't just take your money and run. And I'm actually going to give it back, more or less kind of like AIB. And so we're not going to deal with the dishonest banker, which is a thing, but we're not going to do that. Ivan is totally trustworthy. Totally trustworthy. And here I am, I'm sitting on your 100 euros, and every once in a while you come and say, can I have 10 euros? And I say, sure, no problem. I got it right in here, this here box, and I give you your 10 euros. Okay? This is a bank. This is what's called 100% reserve banking. That is, when you give me money, I keep 100% of that money in reserve in my little box. And then if you come and ask for your money back, I've got it because I've kept 100% of that money in reserve, and I can pay you back anytime you want the money. Okay? Perfectly nice. Okay? Lovely for you. Kind of sucks for me, because in this little scheme of mine, I've got no revenue at all, and I've got expenses, right? I've got the marble that I got to pay for. I have to sort of stand here waiting for you to ask for your money back. I have to get a good box to keep it in so that all the other students that come into this room don't steal it. And so I've got expenses. I've got my time expense. I've got the infrastructure expense, but I've got no revenue. And as commerce students, you should realize that that's not a great business proposition, right? No revenue, lots of costs. Like first thing, right? This is not a good way to get rich. And so here I am not getting rich, and in fact losing my shirt here. So I need to find a way to get some revenue out of this thing, right? Otherwise, this is a dumb business idea. Okay? Now, these days, one thing I could do is I could charge you. I could say, put it in my lovely little safe, and I will charge you 10 euros a month for the pleasure of you putting it in my safe. And you say, that's very expensive. And I say, yeah, but your roommate's going to steal all of it if you keep it at home, so, and that could work depending on your roommate, right? There is only one bank that I know of that works this way. It is Horace Bank in London. I know it's an unfortunate name, but it's spelled H-O-U-R. Anyway, Horace Bank. And this is a bank to the British aristocracy. It's been around since, I think, 15-something, and they basically only deal with noble families and all that kind of stuff, and they keep 100% of the money in reserve, and they always have. And they charge fees, right? So you put your money in the bank, they're going to charge fees to you. I was like, how does this work? How does this work? And I heard this from an economic historian who got access to their records going back to the dawn of time. And it was sort of interesting study in the fact that they were really worried that he was going to reveal that somebody's great-great-grandfather stole money from someone or didn't pay back its debts or something. So there was a lot of security around this because it's all known families and all this. Right? But anyway, since the dawn of time, they've been working on 100% reserve banking, so they need to get revenue from somewhere else. They got lots of expenses keeping the money, and so they have to get revenue for somewhere else. And I sort of looked at their website, and it turns out that what they're really doing is they're kind of a bank on the side, even though they're officially a bank. What they really are is investment advice. So they're people that help you sort out where to put your ill-gotten gains from empire. And they also sell another service, which is kind of interesting, just as a total aside from the lecture. They sell another service, which is get-togethers, where we discuss finances. And that seems like more, let me schmooze with the hoi polloi, right? I'll go to this investment seminar, and it'll be all Horace Bank's customers, and those are, the Duke of What's-It, and so I'll get to hang out with all these guys. Very much like the St. Andrew's PTA. It's all people schmoozing, very little talk about the kids. Yeah, that was a shock, a culture shock for me. Anyway, that's Horace Bank. I think it's the only one I know of. I'm sure there are some somewhere else, but importantly, they are not banks that we know and love. They're very specialty banks doing something weird on the side. It is no bank that you know of, other than Horace Bank now, no bank that you know of works this way, right? So what actually happens is you give me your 100 euros, and instead of keeping 100% in reserve, I only keep a fraction in reserve. Right? I say, let me take this 100 euros that you gave me, and I will keep 10 euros in my box, and 90% of it I will loan out to somebody. And I'll loan out to my friend Gavin, and Gavin has a scheme, he has an investment plan, and he's going to pay me back at the end of the week. I loaned him 90 euros, he's going to pay me back 95 euros at the end of the week. Okay? He's going to pay me interest on this money that I loan him. Okay? And so this works great. This is called fractional reserve banking, which is every bank that you know and love. Well, know and hate. Every bank that you know and hate works on the fractional reserve banking system. That is, they take your money in, they keep a fraction of it in reserve. You should really be thinking in the terms of 5%-ish. But in my little example, it's 10% that we're keeping in reserve. And the rest of it loans out to somebody. Okay? And this works great until you want your money back. Right? And if you come down to me and you say, no, I've loaned all this money out to Gavin. I've loaned the 90 euros out to Gavin, and he's doing whatever scheme he's got. And I've only got 10 euros in my box. And how are we doing here? Just okay, we're good. Got 10 euros in my box. If you come down and say, I really want to go to the movies, and I'm going on a special student rate, so I would like 8 euros. I say, no problem. Here, have 8 euros, because I got the 10 euros in the box. And I say, come back for more if you need it. But in my heart of hearts, I'm saying, oh my God, I hope he doesn't come back for more, right? Because I only got 2 euros in the box at that point. If you come back, instead of asking for 8 euros, you come back and ask for 10 euros. I say, no problem. Here, have your 10 euros. Come back for more if you need it. And oh God, I hope he doesn't come back for more, right? If you come back down instead and you say, I want 12 euros, I just don't have it. I kept 10 euros in the box. The other 90 I loaned out to Gavin, I won't have it for a week. Right? And so if you ask for 12 euros, my bank is bust. I'm totally illiquid. I cannot pay that. People owe me money, but that doesn't help you at all. I had promised to give you back your money whenever you want it, but I just don't have it. And this is how the banking system works. Okay? If you go to the bank and ask for all your money, well, let me add a step. So this is clearly a very risky proposition, right? But I can make it less risky by having more customers. Suppose that I have 10 customers, right? 10 people, each give me 100 euros. And then I loan 90% of that out to Gavin. So Gavin gets 900 euros. He's going to pay me back at the end of the week. And now I've got 100 euros in the vault, right? So I've got 10% of all the deposits in the vault. And so now if you come and say, I put my money in yesterday, but I want it back, I can say no problem, and I can give you all your money back, right? Because I'm giving you, okay, the 10 euros that I kept from your money, but I'm also giving the 10 euros that I kept from everybody else's money as well, right? And so I can pay one customer back. But if 2 customers come to me and ask for their money back, I just don't have it, and the bank goes bust, okay? And so this is exactly how banks work. And you can see that there's problems with this, right? There's problems with this in the sense that even if I do everything well and do everything right, if enough customers ask for their money back at the same time, the bank will go bust. And this is just built into the system, okay? So why do we put up with this system? Like clearly banks are by nature fragile. Right? If we all want our money back at the same time, they cannot give it back to us because they've loaned it to people to buy houses, to invest in factories and whatnot. Right? You know, you can go down to AIB and get a car loan. You can go down to AIB, you can get a house loan. That is AIB taking those deposits and loaning them out to you at an interest rate. Right? And the profit they make is the interest that you're paying on that loan. Right? The fact that the guy who I loan money to is going to pay me back more than I gave him, as long as I don't go bust in the meantime, I get to keep that interest as profit. Well, minus my costs, of course, right? And so there's sort of a trade-off between being safe and being risky, right? If I operate at Horace Bank and I keep 100% of my reserves, 100% of my deposits as reserve, 100% reserve banking, then I'm totally safe. No matter what you ask for, I can give it back to you because it's just in the box. But if I only keep a portion of that in reserve, the smaller the portion I keep in reserve, the more risky my bank is. If I'm keeping 50% of my in reserve, 50% of my customers can come to me and get their money back, and there's no problem. If I'm keeping 10% in reserve, I can only have 10% of my customers come and ask for their money back. I have a problem. If I'm keeping 5% in reserve, which is more realistic in modern banking, then only 5% of my customers can get their money back if they come all at once. Okay? And if I have 6%, the bank goes under. So, but if I have 100% reserve banking, I'm making a loss. If the more I loan out, the more interest I'm going to earn. And so I have this trade-off between safety and profitability. The less money I keep in reserve, the more profitable I am, but the riskier I am. Okay? And so the bank managers have to decide how they trade these things off. And every so often, we get bank runs. That is, where people want to withdraw more money than the bank has kept in reserve. Okay? And you can see it's a problem because it's not just whether you want your money back. If you want your money back, you can definitely get it. If you go to AIB this morning, or this afternoon, and you ask for all your money back, there's no problem. If everybody goes this afternoon and asks for their money back, AIB will go under. Okay? And this is just built into the banking system. So it really is a Tinkerbell sort of situation. As long as we all believe in banks and we clap and say, I do believe in banks, I do believe in banks, I do believe in banks, banks will exist. As soon as we say, I don't trust the banks, we're going to get our money out and the banks will cease to exist. Okay? So it's really, you know, if you believe in fairies, fairies exist. If you don't believe in fairies, they don't. And this is modern banking. Okay? If we believe in it, it works. If we don't believe in it, it doesn't. So last year, we had this bank run. Now, we don't have bank runs very often anymore for reasons we're going to talk about. But we had a bank run just last year, Silicon Valley Bank, in March, which was a big bank in Silicon Valley, which was a bank particularly that was aimed at startups and the funders of startups. Right? So it was a bank that was not, it was run basically like any other bank, but it was really targeting these large investment funds, these vulture funds, these startup funds and stuff. And so billionaires would keep 500 million there, that kind of thing. Right? And so let's see if we can get this to work. So this is back in the day. This is Mary Poppins. Let's see if Mary Poppins will work.
Give it back! Give me back!
Are we going to get it to work?
Give it back! Give me back!
Not really coming through. Okay, you've all seen it anyway. It's okay. Now, Technology. Okay, this guy, our little boy here. What's it, Peter, right? No, Michael. Jane and Michael Banks. Michael is Peter Thiel. What happened there is that it's all these millionaires and billionaires, these venture funds, they all have 500 million or more in the bank. It's really a bank for large deposits to make these big deals, right? And in that case, it's kind of unlike our normal banks in that our normal bank, AIB, has millions of customers, right? Loads of customers, and you don't know them, right? You don't know who has money in AIB. Most of AIB's customers you will never have contact with. But Silicon Valley Bank, exactly the same idea, but first of all, it has fewer but bigger customers that have money deposited in it, and they all know each other, like they go to dinner together, right? And so when our Peter Thiel, got suspicious that the bank was going to go under, he called all his friends and said, like, get your money out of the bank, it's going to go under. And because it's such a small number of people, you could get a high percentage of them just in Peter's friends, right? And all those people took their money out of the bank all at once. It wasn't just randomly people deciding to take their money out. They all panicked and they took their money out. And the important thing here is that all banks work this way, other than Horace Bank, obviously. All normal banks work this way, that if we all want our money out all at once, the bank will go under, right? It is a Tinkerbell thing. And back in the day, like we're talking 1800s, these things happened all the time. It was like a regular thing that banks would have bank runs. That is, every couple years, there'd be a wave of these bank runs and a whole series of banks would go under, not because they were badly run, but just because everyone was taking their money out at the same time. Okay? And we don't see that often. We have Silicon Valley Bank last year, and we have, in 2007, we have Northern Rock. And those are the two bank runs from our time, like from my time, forget your time, from my time, those are the only two bank runs that I know of. I'm sure there's been a few others, but very, very few, where it used to be such a common occurrence that it entered the popular culture. Right? It was a thing that everybody knew about. You could put it in a book, you could put it in a movie, and it felt not normal, but yeah, from people's lived experience, this is how the world works. It doesn't feel normal to us because we don't see it very often. And so the big question there is what's changed? Why don't we see bank runs as much anymore as we used to? Because the banking system is fundamentally the same. The banks, if we all want our money back at the same time, we simply cannot have it. They do not have that money. Okay. So here's Northern Rock. This is 2008. Exactly the same thing happened with Northern Rock. Northern Rock is a more normal bank in that it's serving normal people, not just billionaires. And so, people don't know who's who or anything. But there was some bad news about Northern Rock. Nothing like absolutely horrible. But, okay, let me tell you how Northern Rock came about. Northern Rock was a bank sort of run in kind of a modern style in that they had a lot of debts. They borrowed money. As well as taking deposits, they borrowed a lot. And a lot of modern banks are this way for reasons, but they were borrowing a lot as well as taking deposits. And then the financial crash happened in 2007, and one feature of that was that things were so complicated in the financial system, and then all of a sudden it's crashing, and so nobody knew like how risky any investment was, because people were invested in these very complicated funds that owned other complicated funds that owned other complicated funds. And so you would look at a company and say, I know there's a rotten core of the financial system, and I don't know how connected this particular company is to that rotten core. And in fact, the company itself would not know how connected it was. They were all like just introspecting and saying, how exposed am I to this rubbish? Right? And they were just trying to sort that out for a couple of years. So in 2008, nobody knew if any particular company was solid and decent, or whether they were fundamentally built on a house of sand. You just didn't know. It took a couple years for them to sort of sort that stuff out, which meant Northern Rock had a bunch of debts that were coming due. They had to pay off those debts. And in normal course of events, they would borrow money to pay off the money they owed. Roll it over, as they would say. And that would be totally normal business practices. But all of a sudden in 2008, people weren't loaning money to anybody because you don't know who you're loaning money to. And so they couldn't roll over that debt. Okay? So it wasn't that Northern Rock did anything particularly bad. It's, they were operating in a safe way in the modern style, but because all their debt was coming due at this one particular time when no one was willing to lend, they couldn't roll it over, okay? Just because of when their debt became due. And so everyone said, like Northern Rock is having trouble rolling over its debt. It owes a lot more money than it can pay, so it's going under. And so everyone said, well, I just don't want my money in Northern Rock. And so they all tried to get their money out, and that itself, the fact that everyone was trying to get their money out, caused the bank to fail. Not even the rollover problem. It was the threat of the rollover problem that made everyone want to get their money out, but the getting the money out was what made the bank fail. And it wasn't because it was a badly run bank. It was just a fractional reserve banking bank, and they are always prone to these bank runs. But there is a difference between this and Silicon Valley Bank. Right? In Silicon Valley Bank, I didn't show you pictures of it because it was all these big guys and it all happened on the internet. It wasn't something you could see. It was phone calls and financial transactions. So, whereas this is normal people just getting their money out. But in Silicon Valley Bank, it really was a panic of a Mary Poppins sort. Just people freaking out and trying to get their money out as quickly as possible. I'll get mine. I don't care whether you get yours or anything like that. Okay? Northern Rock, you can see these people are lined up. Okay, they're British, so of course they're going to line up. Just saying. But also, if it's your life savings in the bank, it doesn't matter if you're British. Mary Poppins, those guys, the Bankses, they were British too, and they were panicking. And back in the day, everyone would panic, and they'd close the doors and all of that. That was very realistic, actually. Other than the tuppence. It was very realistic of how a bank run typically works. But for Northern Rock, they just lined up. Right? And you can think, well, suppose you had your life savings in Northern Rock, and you thought they're going to run out of money, and you're going to lose your life savings, and all of a sudden you're going to be living under a bridge. Like, you would push. Like, I don't care how British you are. You'd still push, right? You try to get ahead, because if you get your money back, you're okay, and you can, live in a house. And if you don't get your money back, you live under a bridge. That's a big difference. And some people are going to get their money back, and other people aren't going to get their money back. You would definitely want to be in the front, okay? Just like Peter wanted to be in the front in Silicon Valley Bank. But in fact, they didn't. They lined up. And this is our second big thing that has changed since the Great Depression, since World War II. And that is, if we have the thing, deposit insurance. Our first one was automatic stabilizers. That was a huge change in terms of how the economy works. And the second one is deposit insurance. So nowadays, in the Great Depression, there were loads of these bank runs, as you could imagine. And a bank run has a lot of troubles associated with it. It has, first of all, some people lose their life savings, right? And that's bad. And secondly, it can happen like a perfectly good bank that's doing everything right, that's run in a safe manner, can just go under tomorrow, right? Because if we all take our money out at the same time, they don't have the cash to pay us, and so they go under. They didn't do anything wrong. Everything's being well run, but we stop believing in fairies, fairies die. Same thing with the banking system. And then it catches, right? Because if one bank goes under, like if say, Bank of Ireland goes under, all of a sudden you say, well, I don't know how AIB is, but let me just get my cash out so I don't have to live under a bridge for the rest of my days. And so you get your cash out of AIB, and AIB goes under too. Nothing of this had anything to do with AIB, but people just stopped trusting the banking system. And we really genuinely care about the banking system. So let me just spend a couple words about what banks do for us as a society. Forget about the individuals involved, but as a society, banks are really, really, really super useful. Because what they're doing is, like, each of us have 100 euros, right? That 100 euros is too small an amount to do anything really useful with. Right? There's nothing you can really do with 100 euros other than spend it, right? But if we all put our money into the bank, now all of a sudden, the bank has 10 million euros, right? And they can loan that 10 million euros out to people, And that 10 million euros can turn into houses and factories, and people with business ideas can get those things going. And so, like big companies, now you think about your Hewlett-Packards and your IBMs and these big companies, they can borrow money directly from the money market. They can go out and they can sell bonds and they can get directly from the money market. But if you're a mom and pop operation, if you're thinking of starting a restaurant or a dry cleaner or something innovative that's going to create jobs, that's going to be good for society, people need clean clothes, I'm just saying. The only way you can get the capital for that is to borrow from a bank. And the banks have that capital because they've pooled all of our little deposits into one place. And so all of those small businesses, they are happening largely because we have a banking system. And if we don't have a banking system, it's going to be very hard for small businesses to get started. And small businesses create the lion's share of jobs. New jobs come from small businesses. They turn into big businesses sometimes, but that's where jobs mostly come from. And it's a big source of opportunity for lots of folks. So small and medium-sized businesses, think businesses with 500 employees or less, the only way they can get financing is through banks. And so we need a banking system to make that happen. And that's the vast majority of businesses in Ireland are financed that way. So we really do want this banking system to work. We don't want the banks to be going under. When they do go under, it takes down other businesses with them. So if the bank goes under, the dry cleaner needed, to borrow some money in order to buy materials for next month. It can't do that, therefore it can't dry clean stuff. Next month, the dry cleaner goes under. Right? And so it has a knock-on effect. When these banks go under, it ruins a lot of other businesses as well. And not only can't they expand, but they count on these small loans to get through the next month, the next payroll, and all of this kind of stuff. And so we really, really want the banking system to work. Okay? For these reasons. This is why we care about the banking system. And so what we did after the Great Depression, particularly after the Great Depression, everyone saw around the world, not any one particular country, it happened at different times, different places, that really these kind of bank runs were really disruptive. And what we're going to do is we're going to say the reason it is so disruptive is because if you see the bank not giving tuppence to Michael, you say, well, they don't even have tuppence, I better get my money out, right? Just like in Mary Poppins. And you need to get your money out before everyone else, and so it causes the panic. And so what we've done instead nowadays is the government, or the central banks, but we can think government at this stage, has said, no, don't worry. If it's a reputable bank that we've certified and they run out of money, we will give you the money. You will not lose your life savings. Okay? Which is why when we're in Silicon Valley Bank, in Northern Rock, these people could line up. Right? Because if they got their money out, that's great. But if they didn't get their money out, it's not like they were going to live under their bridge. They were going to have to fill out some government forms, and it would take a week for the government to give them their money, right? Because those deposits were insured. And so you don't have the same sense of panic. Yeah, you'd rather you got your money out and not have to deal with the government, because that's always a pain. But in fact, in pretty short order, you're going to get your wealth back. You're not going to be living under a bridge. So if you're way back in the line, it's okay if you don't get your money out. Yeah, you'd rather get it out, but your life isn't over if you don't get to the front of the line, right? And so it's fine to wait in line. Whereas back in Mary Poppins times, 1800s, it was not fine. You would lose your life savings. And which is why Peter Thiel and the Silicon Valley Bank and all of those guys were panicking in a way that these guys are not. Because these guys are normal depositors, and this deposit insurance isn't for any amount of deposit. It's only up to a certain amount. I think it's 300,000 euros, 250,000 euros, somewhere in there. If your deposits are less than that amount, the government will give them back. Central bank, actually, but the government will give them back. If it's more than that, you're screwed, you're on your own. Okay? So in Silicon Valley Bank, they were very large deposits, 500 million, 50 million, 300 million, these kinds of deposits. And only 250,000 was going to be given back, and the rest would just be toast. And so those guys had reason to panic. Whereas these guys in Northern Rock, these are normal people. They have normal amounts of money in the bank. And so it's all less than 200,000 euros, and so it's no big deal if it doesn't get paid back. Okay, the government will pay it back. Now, That's very nice of the government to do that, but it's not just a free ride for the banks either. Right? You can't just say, well, the government will guarantee it. The government, as a result, came in and said, look, we're going to guarantee your deposits, but you have to be well run. You can't just be doing any random thing you want. We're going to guarantee your deposits, but sort of in exchange, we're going to regulate the way you do business. And so banks are very, very regulated, which is why I cannot start the Bank of Ivan here. You have to have a certain amount of capital in order to start a bank so that they know that you have the ability to mostly pay people back. So Bank of Ivan's not going to work because I'm not big enough to do it, like financially big enough. Physically, I'm fine, but financially big enough to pull the thing off, to satisfy the requirements. And they have lots of requirements on how you operate your bank. So remember, we have that trade-off between keeping lots in reserve and being safe, or keeping very little in reserve and being profitable. The banking authorities, they say, if you want to be a bank and get this deposit insurance and call yourself a bank and to take deposits, you have to keep a minimum amount in reserve. Think 5%. Right? You have to keep that in reserve. You can't run 2% reserve banking and only keep 2% in reserve. We'll shut you down. Okay, I'll let you go, and we'll talk next time.